Okay, what else we got? Tax. Tax is something that might stop you getting from your start to your goal of staying in business. What am I talking about? What issues do we have in tax? Well, the first thing is we've got to know what tax we're talking about. A lot of people come in and say, I want to know the tax consequences of doing this. Well, it depends on what tax you're talking about, and each tax, it can be a different consequence depending on the different types of tax. Of course, there's income tax, there's capital gains tax, there's GST. So it depends on what tax you're talking about. So that's a definition that you need to look at first. Is the company structure that David and Angela have in place a good one to minimise tax? A lot of people come in and say, I want to have a company because I know I pay less tax in the company. Is that really the case? Not necessarily, and in a lot of cases, no. Company has a set tax rate, and a lot of people have higher tax rates personally than in the company. But it only works at the company tax rate while the money stays in business, in the company itself. Once they pull it out and start using it for private use, then it gets upgraded to their own tax rate. So they pay the difference, or it comes out as wages or whatever. So while the company structure might be good for tax, for income tax, it may be good, especially if you're continuing to buy more stock, build up in stock. Well, the tax rate stays at 30%, while ever that money's still in there and that money's tied up in stock, so it's still in the company. So it does work in that situation. But from capital gains tax point of view, if you go to sell the business, the company is a very poor structure. So it really depends on the type of tax you're talking about. Has anyone heard of Division 7A? Division 7A is part of the Tax Act that virtually prevents people from just taking the money out of the company and not paying tax on it. In the old days, it was good. You didn't take it out as wages, you didn't take it as a dividend, you took it out as a loan. And so what you'd have was companies with profits all built up, but no cash because they'd taken it and gone and bought a boat or a jet ski or something like that. This Division 7A now stops you doing that. It forces that if you take money out of the company, that it either has to come through a tax avenue, such as wages or a dividend, or it has to be a commercial style loan, so a loan agreement, paying interest, etc. And in a lot of cases that doesn't work for people because they don't need the extra interest income in the business that they're not going to get a tax deduction for in their personal name, so it works against them. So the company structure has got issues in regard to that as well. But should the dominant concern be tax when we're looking at all these issues? Well, I say no. It should be one of the considerations, and I'm a tax accountant, and I'm saying no, it shouldn't be the dominant one, because, as I said before, there are two different aspects of tax. For example, there's the income tax and the capital gains tax. They can be opposed to each other for making a decision on which way you would structure. But you should take both of those in consideration and weigh them up in regard to the whole works. But asset protection may be a much bigger issue than tax. Things of that nature. So when you're looking at the problem and defining the problem, tax shouldn't override everything else when you're making those decisions.